sure you'll agree that we have a very eminent panel here. I might pass straight across to Paul.
Thanks, Deborah. I'm going to just sort of make a few opening comments about social infrastructure, and the points there are the ones I'm going to cover. If I start by just sort of differentiating social infrastructure from the other classes of infrastructure, and I think it's probably best encapsulated by a single differentiator, which is revenue, or the revenue source. Economic infrastructure, you'd all be familiar with, it essentially has market-based demand, risk associated with its revenue. There's regulated utilities, which have regulated returns, and then there's social infrastructure, and the key revenue component of that is contracted revenue streams from government. And essentially what that does is create a different sort of risk-return profile for social infrastructure compared to other classes of infrastructure. When we eliminate that usage and that regulatory risk, essentially the key risk is performance risk, and it's the performance of construction and the completion of assets, and then the long-term ongoing service delivery associated with those assets. And I think that what we found in Australia particularly is that those risks are relatively easy to manage and are outsourced on robust contractual terms to counterparties who are well placed to be able to take that performance risk. The other component of the risk-return equation within social infrastructure that perhaps isn't all that well understood is that we do have a unique counterparty, being AAA governments who are willing to share risk. And I think this is quite important in understanding the risk-return equation within social infrastructure. The governments are willing to share risk and all manner of risk, particularly those risks where there's no one party that can actually control the risk. And some examples of that might be repricing services through a concession term, particularly labour-based services. We usually have a mechanism that reprices services, labour-based services. Insurance costs, which can sometimes be quite volatile, government will share that risk. Government will share refinancing risk, which has been quite topical. And even things like uninsurable force majeure risk. Government will share that risk with investors and with the counterparties. So what has this led to in terms of performance as an asset class, and how does social infrastructure perform? Essentially, because it's inflation-linked contracted government revenue streams, it largely behaves like an inflation-linked bond. There are some additional risks, but essentially its performance is very similar to inflation-linked bonds. There have been particular projects that have had issues, and even those headline-grabbing projects that we've seen over the last few years, there have been problems, but usually those problems have been for the service providers and not for investors, and investors have been well protected through those issues, like the Southern Cross Station and some of the early hospital projects that were procured through PPPs. That's not to say that these are passive assets. You generally have to actively manage and understand the stakeholders. There are numerous stakeholders in social infrastructure projects, and those stakeholders need to be understood and the assets actively managed. And then there's the question of financial structures and ensuring that there are appropriate financial structures, and refinancing risk has been a particular issue. We'd advocate that you're far better off sharing refinancing risk with government, as they will do, as opposed to the likes of online insurers, and that's where we have seen some problems with refinancing even in social infrastructure. I think on the question of future opportunities, clearly you need governments to continue to believe in PPPs and believe that they're an effective procurement method. I think largely governments do recognise those benefits, and that we have seen that the financial and contractual discipline that PPPs generate is a benefit to government, and also the innovation that the private sector is able to bring. That innovation comes in many forms, whether it's in functional design, whole-of-life costing, and commercial opportunities that traditionally governments wouldn't pursue. So I think we're seeing a very strong sort of pipeline from governments, and I think that governments will continue to procure infrastructure this way. I think the projects are getting a lot larger, and really there's an opportunity now, and I think a concerted effort by government and industry participants to bring superannuation and long liability insurance investors into this space as well, to marry those very long-term, low volatility, inflation-linked returns to what would seem to be the natural pools of capital that would be attracted to social infrastructure. So,
thank you, Paul.
Yeah.
We might pass straight across to Mark, who will talk about regional infrastructure.
Thanks, Deborah, and of course it had come as no surprise that my involvement in this field is really focused on regional Australia and the opportunities that increasingly are going to present themselves in regional Australia in infrastructure investment as an asset class, and particularly with the changing circumstances, if you like, economically with local government, for example. Local government are facing exactly the same capital pressures as other levels of government, and unfortunately managed to get squeezed by other levels of government. The Price Waterhouse report indicated that local government infrastructure backlog or requirements somewhere between $12 and $15 billion, just in terms of the infrastructure that local government is responsible for providing in the communities across Australia. Local government owns about 36% of the non-financial assets that exist amongst all levels of government, yet only spends about 2.3% of GDP on the maintenance of that infrastructure. And of course, so there's increasingly a greater demand on ratepayers providing services that can be otherwise provided through the private sector. And of course, those non-financial assets, the state levels of government own 56% of those, in the Commonwealth only 8%, yet the Commonwealth probably the largest revenue collector, albeit then that's spread back through the other levels of government. So the challenge that is going to confront regional communities and through them, or through their local government authorities, is how they can continue to afford to provide the services in different areas that traditionally we've been used to across Australia. And the clear answer is they're not going to be able to, and it provides an opportunity for investment in a range of different asset classes, whether it's the management of waste, the provision of services like water or energy, and in some circumstances the provision of services in the food chain. And one area that we've taken a particular interest in is the aggregation or regionalisation of livestock exchanges across Australia, where there is a very, very good financial model to be put in place. A service that's basically your local sale yards in the majority of regional centres across Australia, owned and managed and funded by the local ratepayers, and often screaming out for capital investment to provide a better service in that critical food supply chain that Australia is involved in. And there is quite a significant opportunity in that regard to invest in that space and to manage that and provide much better facilities for the industries that are going to use it, all done purely on a user pay basis, as would be the case in better management of waste, to introduce and deploy technology that is going to relieve the impact on the environment through landfill and the like. Water storage and transmission, often in smaller regional centres in Australia, is being left to local government with less and less support from other levels of government to provide those services, and yet the demand there from the population, and of course a gradually decentralising population in Australia. And of course the fourth focus that we have in regional Australia is on energy production. Recently the federal government passed their part of the renewable energy legislation, where they set the renewable energy target at 20% by 2020, and so energy distributors are going to have to provide 20% of the energy they do as green energy, which got to be generated in the first place, and one of the more efficient, or still currently the most efficient method of generating renewable energy is through wind power, and most of the wind farms, sometimes as contentious as they are going to be deployed in regional Australia. And so there is it's a new area. It's probably had less focus than you know, your toll roads and your airports and that type of infrastructure in the past, but critically important. And of course, anybody that lives in regional Australia would also recognise that just because we live in regional Australia doesn't mean we should be disadvantaged to the rest of Australia, and that goes to the deployment of you know, the accumulated savings funds that exist in this country now that may in some cases get invested into existing or improved infrastructure in regional Australia. I noted in doing a bit of research in this space that often the problem that's perceived is how quickly capital can be deployed on the ground. You know, what the deal flow in moving through the pipeline is, how quickly that's going to operate. And what we've done is, you know, to an extent worked in reverse in setting up a very solid pipeline of projects already across Australia that can absorb significant amounts of capital to be invested up front in addressing that perceived problem that's existed in the past. But at the end of the day, there are some very, very good opportunities, particularly in those 4 areas that I highlight for, you know, long-term stable investment.
Thank you, Mark. We'll pass on to Kyle, who'll talk about the big picture. Thank you, Kyle.
Thanks, Deborah. One of the questions I think that gets asked quite often in the current environment is, has infrastructure performed as an asset class as would have been expected? And the answer really is yes and no. It's certainly performed from an operating perspective pretty much exactly as expected. So from the perspective of the low elasticity part of the sector, water, residential electricity, district heating, that's performed from an operating perspective almost exactly as forecast, and the operating characteristics of those assets are targeting almost to the dollar from a budget perspective. In the economic subsector, airports, seaports, toll roads, they're really performing as expected in the sense that they're a barometer for regional economic activity. They're clearly tied to GDP, global trade, gross state product. And if you look at the performance of toll roads or assets across the globe, it's a very good indication of what's going on in that region. So that performance is really as expected, probably more volatile than was anticipated, and I think that's part due to the quickness or the speed in which some of that volume fell off, but still a very good barometer for local economic activity. I think what was less expected is the volatility associated with some of the valuations of these assets, and that's both in the listed space and in the unlisted space. These are assets that are often characterized by a 50 or 100-year life, and 12 months of reduced passengers or traffic has a relatively inconsequential impact on values. But where the real valuation volatility is flowing through is really on the view of longer-term economic activity. So valuations are now reflecting a view that economic activity is not only going to slow for a year, but may slow for 10 or even 15 years. And that's brought a lot of volatility through the sector in terms of the valuations. And that certainly was something I think that was unexpected from a sector perspective. The GFC has raised a number of interesting lessons, some of which were around the edges and some of which probably should have seemed obvious in the past. It's a sector globally that's characterized by relatively high union membership, and what that means is there tends to be more defined benefit schemes and more underfunded pension liabilities. It's not the only sector that's got that trait, but certainly it's a sector that has got that in a more significant sense, and that's an issue that's had to be dealt with across a number of jurisdictions and asset classes. It's a sector that we often characterize as being inflation protected, and you know what that means in practice is it's deflation exposed. And that should have been obvious, really, but it wasn't. And I don't think that there are many investors or managers who forecast a sustained period of deflation. And you know what it's meant in practice is that owners of regulated assets, particularly in the UK, have had to tip in capital on the back of deflation, because where inflation pushed their revenue stream up, deflation is actually pushing their revenue stream down. I think another lesson that's come out of the GFC is the importance of investing alongside like-minded investors. There's a very different ability to address issues as they arise if you're sitting alongside investors that have the same investment time horizon as you have. That characteristic changes if, for example, there's a listed fund in the room who's much more potentially driven by cash yield. And that mismatch in horizon can have a very big impact, and I think that's a key lesson that's been taken out of the GFC. From a capital perspective, in many ways the GFC is quite positive for the sector. Certainly there's a lot more discipline coming through the banking market. Covenants have tightened. There's a fundamental deleveraging. And longer term, that's positive for equity investors because that risk allocation will ultimately flow through to equity and protect equity positions. Additionally, it's clear that there's less capital available than pre-GFC. What that's meant is equity is much more in control of the process. In the sector, particularly in Australia, which was characterized by investment banks driving transactions and being in the driver's seat, capital now is back in the driver's seat, and that's also really positive for the sector generally. So, going forward, things are getting done across our two portfolios. We refinanced in total $3.5 billion of debt during the GFC, so it was still possible to access credit markets. Credit's starting to come back into the market for new transactions, but I think the overall reduction in capital available in the sector is quite positive for existing long-term investors in the asset class.
Thank you, Kyle. We'll move into the second stage of our panel, and that's where I have the prerogative of asking the panel questions. We've got a number here. We'll try to get through as many as possible before we open up to you. And I might start with something that's probably very topical to our audience, and there's been a great deal of press for the needs, and this is for all three of the panel to comment, in the press about the needs of Australian infrastructure investment being addressed by the pool of capital that sits within our superannuation funds. Do you believe that the infrastructure problem can be addressed by superannuation funds? Kyle.
Well, I guess I'd start by saying it's not clear to me that there is a problem. There haven't been any deals that I've seen that couldn't get done. There's been a couple of small deals that got delayed, but broadly speaking, the problem, which has sort of been portrayed in the press, doesn't seem to be a problem with available capital. I mean, even DCEL got done and got a bit of support on the debt side, but there was equity to get that done. So even through the GFC and now, I don't think there's a fundamental problem with capital availability. I think that from a policy perspective, if there's a desire to bring a lot of infrastructure forward and build new infrastructure, there's certainly the capability to bring superannuation money into that in a faster and more meaningful way. But that's a different policy initiative and really goes into a lot of issues around bidding structure, timing, and some of the issues that Mark raised.
You seem to agree with that, Mark. Is that?
Well, I do. I think that the perceived problem with the so-called infrastructure bottleneck certainly can be ultimately attractive to investment of superannuation funds, but the availability of capital is not necessarily the problem that's causing the bottleneck. It's I suspect it's more a problem of philosophical points of view of different governments, bureaucratic systems in terms of dealing with the needs, and then really ultimately once identifying that there's a problem that needs to be addressed, putting a policy in place to address it, getting a broad commitment to that from different levels of government. Then once you go to chase the capital, I think that and if part of that decision-making process is to allow private sector capital to go into a project, then as Kyle says, there's normally no problem in finding the capital. But it's a lot of the preparatory work in advance that has created the bottleneck that we have in this country. Unfortunately, it often comes back to the federal structure of government we have in there. Now, that's not likely to change because, if you sort of ran a referendum in this country to to change the structure of government, it'd get beaten every day of the week, regardless how much we complain about how over-governed we are. But the reality is that if you go to look at addressing any specific infrastructure problem anywhere, you're going to find a role and an input from all three levels of government in getting through that decision-making process.
Obviously, with PPPs, you've got a very close link there with governments. Do you find the same sort of issues?
Yeah, I agree with Carl there. I think the capital is certainly available, and in many ways it is the government processes that need to evolve a little bit. I mean, we're fairly good here at procuring infrastructure, and I think we've probably benefited from a very competitive market, and governments have got pretty good infrastructure sort of initiatives banked and funded and constructed because of that intense competition. Sometimes it's gone too far. But I think that pendulum is sort of swinging back a bit, and I think governments are thinking about how they can better improve their tender processes and their procurement processes to make it more attractive to superannuation funds and the like.
On the same topic of social infrastructure PPPs, they're not unique to Australia. What's been the experience with social infrastructure investments overseas?
Well, certainly the UK probably leads the world, and they're called PFIs over there. And they've probably got over 700 projects that have been done in the last 15 years. And what has happened over there is quite a sophisticated institutional market has developed. There are 3 listed funds and a dozen or more unlisted funds where institutional investors are investing in PFI. So certainly the UK is a sophisticated market with both primary and secondary sort of activity. But we're seeing it sort of catch on in many parts of the world. Yeah. Canada is becoming more active. Asia is starting to look at it, and obviously Australia has been one of the leaders. Yeah.
I just said in the US, it's starting to become something that is viewed as being inevitable. Local, state, and federal governments are all running massive deficits. There's a tremendous infrastructure need. And while it's a change in the way that people view the provision of services, it is inevitable. And Schwarzenegger passed a law in February allowing unlimited PPPs into the transport sector. New York has now not gotten to the stage of legislation, but they've actually issued a report saying we don't have a choice but to bring private money in. And Massachusetts has just gotten rid of the Massachusetts Turnpike Authority, again on the same front with the recognition that it's inevitable if we want to provide these services at a reasonable level.
Mark, just a question for you. The private sector involvement in infrastructure provision requires scale in order to be cost effective. Do you believe that local government infrastructure needs to provide or can provide this necessary scale?
Yes, it can, and again, it comes back to the policy decision and the philosophical viewpoint of individual entities in being able to come to the point of saying, well, historically this service has been provided by the public sector. It's been funded by ratepayers, and not all ratepayers may get a benefit from that particular service. So it's more or less the socialisation of the cost of a service to a particular part of the community, and they need to get beyond that and think about the operation of their business, the status of their balance sheet, if you like, and move some of those services off their books to be provided by some other entity purely on a user pays basis. And the answer to the question is yes, I think they can. And I'm not sure, I should know the number, but I don't. But there's several hundred entities across Australia that are all providing unique services in their communities that probably can be done a little bit more efficiently. And we've got to face the reality, and it's like facing the reality of through social infrastructure and PPPs, being able to do that, whether it's health or education services or the hard infrastructure underpinning that, it goes to exactly the same set of circumstances as far as many of the things that the local government provide.
Yeah. Carl, a question for you. We talked about credit, or some discussion this morning about credit and availability of it. How long do you think it'll be before banks really start to lend for infrastructure projects?
Well, I think it's starting now. I said that there were refinancings that got done right through the GFC. There was kind of a bizarre period that went on for about 6 months where no Australian bank would lend for any more than 3 years. And we had discussions with the Australian banks and said, you're creating your own liquidity problem 3 years from now because you're only lending 3 years and everybody else is only lending 3 years, so we're going to have this mass of refinancings in 3 years' time. And they all said, yeah, we know we have a problem, but nobody wants to go out to 5 years. So there's been movement on that front. There's now capital that goes out 5. There's some that goes out 7. But ultimately, there needs to be some competition. The banking market here is small, and I think that competition is, first of all, going to come from the domestic fixed income market. I think that a number of superannuation funds are targeting that as an asset class. That creates demand for those bonds and competition from the banks. And certainly the U.S. private market and the 144A market is accessible. The challenge there is always swapping back the currency, but in terms of tenor and pricing, that's also an opportunity that's starting to open up and provide some competition. Competition is what will ultimately force the banks to start lending in a more active way, I think.
Yeah, I agree with that. I think that we've found in Canada, which probably leads Australia a little bit, is the return of the capital markets, and 2 PPPs that we closed this year. The first one had 30-year capital markets, there was only about 120 million available, but 3 months later there was twice that amount available. So we're seeing sort of 30-year bond issues, which really is probably a better source of debt funding for these sorts of projects, come back to the market, and hopefully it's only a matter of time before Australia sees the same thing.
Mark, many investors have had limited access in developing a portfolio of regional infrastructure assets of a critical mass and dismantled it due to lack of deal flow. How is Palisade addressing this issue?
There's been an enormous amount of preparatory work, I suppose, you could put it, in identifying opportunities and working with local authorities. I mean, the classic example is the network of regional livestock exchanges that we're putting together, and it's a demonstration model, if you like, that already is operating at Blaney, and other local authorities have seen how well that's gone, and that was sort of a regionalisation issue where there were 3 local authorities that were individually running operations that weren't financial, that weren't viable, and they came together and said, let's have one really good facility here, go to the private sector. That was an investment of about, I think, $23–25 million. So there's a demonstration unit there. Off that, we've had many other local government authorities actually come to us and say, take over our operation, then build us a new one. We'll give you the mandate, and you can do it with confidence, and the risk is low because you're operating almost in a monopolistic situation. But it's providing a service. The competition is amongst the people that use the facility rather than the facility itself. And so it's given us an ability to be able to line up a significant pipeline for investment opportunity. Over the next 12 months, there'd be probably $150 million worth of investment that you get onto the ground and ready to go. And that's also the case in waste disposal and also in the renewable energy space.
And is some of that funding coming from the government fiscal stimulus package?
No. I think that most of the fiscal stimulus package that finds its way to local government is going to go into, the investment in non-commercial assets that local government is responsible for services that they can't fund with debt financing. Their rate base generally is probably servicing existing debt and paying salaries, and so they'll have a wish list of non-commercial assets that need to be either upgraded or put into place, and a lot of that fiscal stimulus money will go to there. I mean, it's been a proven fact over the years. I mean, in the Keating government, they identified in the early 90s that if you want to get money to hit the ground quickly in a fiscal stimulus sense, then local government's always got a bunch of projects ready to go. They're shovel ready, if you like. And it's the case today, and the government's done the same thing.
I'm just going to ask a couple of questions that were emailed through from our audience. One of them's to Paul. It's quite a lengthy question, so please give me a little bit of leeway here. Can you give me a breakdown by percentage of profit share of consortium members from each deal in PV terms, being the builder, financial advisor, investment bank, banks, financiers, facilities manager, the fund manager, equity, etc.? Now, it's obviously not the sort of question that most people would pose to you, and you did have some time to think about it. So
yeah. Well, obviously it's not an easy question, and I could sort of duck it by saying that every project is different, and every consortia contracts differently, and there are different arrangements, obviously, around different projects. But I will try and answer it in the sense of a well-balanced consortia, and when I say that, I mean a consortia that's not dominated by either a contractor or an investment bank, but is a well-balanced consortia. Typically, the sort of profit, if you like, or the margin will follow the risk, and therefore the percentage of profit will follow the percentage of risk or the percentage of service delivery. So I think that you can say in a typical project, the majority of the return will go to the building contractor and the facility manager, and that might be probably the contractor might be earning sort of 30 to 35% of the pie, so to speak, given that we're talking about the total pie. The facilities manager might be in the order of sort of 20 to 25%, I'd guess. You'd then get to the financial advisor or the investment bank who might be earning sort of 10%. Debt providers, 15%. Equity providers, probably similar, 10 to 15%. And I think the last one on the list was the humble fund manager,
That's
who
correct.
you're lucky to earn 2 to 3%.
Thank you, Paul, Carl and Mark, and if you'd like to put your hands together, please.